Clapperboard emoji. Title: The Wheel Strategy Explained Step by Step. Options Trading for Beginners. If you're new to options or just need a refresher, this video is for you. Today we're diving into one of my favorite strategies, the wheel. It's simple, powerful, and yes, even Warren Buffett uses a variation of it. Let's break it down. Part 1, Understanding Option Basics. When trading options, you can buy or sell calls and puts. Here's a quick summary. Buying a call equals right to buy 100 shares at the strike price. Selling a call equals obligation to sell 100 shares at the strike price. Buying a put equals right to sell 100 shares at the strike price. Selling a put equals obligation to buy 100 shares at the strike price. Part 2, What is the wheel strategy? The wheel strategy is all about getting paid to wait to buy stock, and then getting paid again to sell it. Here's how it works in 3 steps. Sell a cash secured put on a stock you want to own. If assigned, buy the stock and then sell covered calls on those shares to generate income, over and over again. Part 3, Real example using Square. Let's use Square as an example. Say it's trading at $120, and you'd love to own it at $100. Instead of placing a limit order, you sell a put at the $100 strike, 30 days out, and collect $3.20 per share, or $320 total. You're now obligated to buy Square at $100 if it drops, and you got paid up front just for being willing to do that. Light bulb emoji. 2 outcomes. Stock stays above $100, you keep the $320 and repeat the process. Stock drops below $100, you're assigned, you buy 100 shares at $100. Part 4, Now you own the stock. Great, now you own 100 shares of Square at $100. What next? You sell a covered call, maybe at $110, 30 days out. Let's say you collect another $5, that's $500 income. Abacus emoji. Example scenarios. Stock drops to $90, unrealized loss of $1,000, but you've collected $820 in premium so far. You're still in the game. Stock rises to $110, your shares are called away, you make $1,000 in capital gains plus $820 in option income. Stock goes sideways, you keep selling calls and stacking premiums. Part 5, Why it works. This is why it's called the wheel, it keeps spinning. You sell puts until you're assigned, then sell calls until you're called away. Repeat the cycle, collect premium, and build income. White check mark emoji. Key advantages: earn income while waiting to buy stock. Lower your cost basis with every trade. Works great in sideways or rising markets. Part 6, Final thoughts. This strategy isn't risk-free. If the stock crashes, you're holding the bag. That's why step 1 is choosing the right stock. Pick something you're comfortable owning long-term. And margin can increase returns, but only use it if you fully understand the risks. Thumbs up emoji, like, subscribe, and share this with a friend if it helped. Drop a comment if you're already using the wheel or want to start.